Welcome back to Alpha Intelligence by Himalayan Stocks Gurukul. 23,000 U.S. jobs just vanished overnight, forcing the Fed to flip from rate hikes to rate cuts in just 30 days. While inflation scorches at 3.5%, investors are already rotating into isolated pockets of growth. SpaceX recently surged 15.8%, which raises a key question for your portfolio. Is India's space sector the next major opportunity? The U.S. recession wave is here, and India's stock market stands exposed. Today, I'll reveal exactly what to buy and sell, the 5 stocks every Indian should grab now, and the strategy to protect your wealth from the stagflation trap. Watch this before your retirement is impacted. Let's get started. To understand your next move, you have to look at this divergence. We have a labor market that is beginning to contract, yet stock indices are still trading near record highs. July's negative payroll print was the first in 5 months, but the weakness was already building in the revisions. The Bureau of Labor Statistics slashed a combined 103,000 jobs from the May and June reports, revealing a labor market that was significantly softer than previous data suggested. While the job market cools, inflation remains stuck at 3.5%. Geopolitical tensions have created a supply shock in energy markets, and those rising fuel costs are now filtering through the economy, squeezing margins for businesses of all sizes. We're seeing the results in the service economy. Retail trade shed over 19,000 jobs in July, while the hospitality sector lost 40,000 positions over 2 months. Even local government education is under pressure, losing nearly 50,000 jobs as budget constraints take hold. This data has economy. Retail trade shed over 19,000 jobs in July, while the hospitality sector lost 40,000. Fractured the consensus inside the Federal Reserve. 3 regional presidents recently dissented to demand a rate hike, while doves are pushing for immediate cuts. Amidst this split, Chairman Kevin Warsh has adopted a silent strategy, removing forward guidance and leaving the market to interpret the data without a clear policy signal. This is the definition of a stagflation trap: high inflation and a cooling labor market combined. It represents a period where the traditional engines of global growth begin grinding to a halt under intense price pressure. In this environment, standard diversification doesn't work. When market logic breaks, you have to be much more precise with your capital. When the headlines get this loud, it's tempting to move everything into cash. But with inflation at 3.5%, a cash-only strategy guarantees you lose purchasing power every single year. The parallels to the 1970s and 80s are striking. Back then, the Fed had to choose between letting inflation run or triggering a recession with massive rate hikes. Paul Volcker eventually broke inflation, but only after rates hit 20% and the economy suffered a double-dip recession. But staying in standard consumer stocks is also risky. As the U.S. consumer pulls back, companies in the retail and discretionary sectors face shrinking margins and declining valuations. You can't look for a single, safe asset anymore. Success now depends on choosing a strategy that fits your specific risk tolerance. We use this strategic framework to evaluate assets during stagflation. We plot them based on their vulnerability to a recession and their potential upside as the Fed eventually cuts rates. Category 1 is the safe havens. Spot gold recently rose to a 7-week high of $4,347 per ounce, a weakening US dollar. We're already seeing this play out in the currency markets, where the yen surged as investors began pricing in a shift from the Fed's hawkish policy. For Indian investors, the best way to access this is through gold ETFs or sovereign bonds. They offer a liquid way to protect your principal without the storage risks of physical bars. The trade-off is simple. Gold protects you during a dollar crash, but it pays no dividends. If the economy manages to avoid a recession, gold will likely underperform compared to growth stocks. Category 2 is the defensives. Capital is rotating out of domestic retail and into export-heavy sectors, like Indian IT and Pharma, which sit in the lower left quadrant. The currency dynamic here is key. While high oil prices strain the broader Indian economy, they often lead to a weaker rupee. For companies that earn their revenue in dollars, like TCS or Apollo Hospitals, that currency weakness actually expands their profit margins. These sectors are also benefiting from a no hire, no fire trend in the US. American companies are using automation and offshore tech support to maintain productivity while they freeze their domestic hiring. The risk here is a deep US recession. If American corporate budgets are cut, Indian IT order books will eventually decline. These defensive sectors provide a structural floor for your portfolio, but their growth is still tied to the health of global corporate budgets. Category 3 is the innovation resilience. These are the sectors currently trading higher despite the broader economic slump, positioned in our high upside quadrant. As human labor becomes more expensive or scarce, companies are turning to AI and automation to protect their profitability. This shift is a structural driver for the tech companies providing these solutions. This explains why SpaceX rose 15.8% after its lockup expiry, and why firms like Atlassian and Microchip are beating earnings estimates. Investors are staying in names that represent the future of productivity. Expected rate cuts, which some analysts now predict for October, act as a primary valuation driver for these high-growth sectors, as cheaper capital makes long-term innovation more attractive. The trade-off here is volatility. You are paying a premium for these stocks during a time of high uncertainty, which means you must be prepared for significant price swings. These stocks are the primary play for a pivot rally. They offer the highest potential returns if the Fed prioritizes supporting the economy over fighting inflation. To navigate this trap, you have to use the decision matrix that matches your current financial phase. Profile 1 is the capital preservers. If you are a retiree or nearing retirement, your goal is to protect your principal from a potential market correction. You should consider reducing exposure to consumer discretionary stocks and moving that capital into gold ETFs and pharma, while maintaining your regular SIPs to average out your costs. Profile 2 is aggressive growth. For younger investors with a long time horizon, this volatility is an opportunity to position for the next cycle. Look past consumer staples and buy the dips in AI, tech, and space-related ETFs. You are front-running the eventual shift in Fed policy. In a divided economy, you cannot afford to be indecisive. Pick your path and execute it. Global uncertainty creates panic for some, but for the disciplined investor, it creates an entry point. And that's how you turn this global chaos into your personal opportunity. Remember, in times of crisis, the disciplined investor always wins. If this strategy resonated with you, hit that like, share this with a fellow investor, and subscribe to Himalayan Stocks Gurukul for daily market wisdom. Stay safe, stay rich. See you in the next video. You have the facts, now you have the playbook.